Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. In my last video, The 5 Key Takeaways of the Intelligent Investor by Benjamin Graham, I introduced to you a concept called dollar cost averaging and the importance of this in achieving healthy long-term investment growth. Today, I'm going to cover dollar cost averaging in more detail, and we'll look to give you an overview of 1. What is dollar cost averaging? 2. How does dollar cost averaging work? 3. The benefits to the average investor of using dollar cost averaging. Fourthly, who should use dollar cost averaging? And fifth, a worked example. So, without further ado, let's kick off with the first agenda item. What is dollar cost averaging? In short, dollar cost averaging is an approach to investing whereby an investor spreads out their purchases over time so that the total price paid for their investment is less affected by market volatility. It is a strategy that can make it easier to deal with uncertain markets by making purchases periodic, regular, and automatic. In its simplest form, it involves investing the same amount of money at regular, periodic intervals, regardless of the stock price. The theory behind it is that sometimes you will buy when the market is high, sometimes you'll buy when the market is low, but over the long term, the average price paid will be somewhere in between. As a result, over time, this enables the investor to build up a portfolio of stocks and shares that would be seemingly purchased at what is a fair price. Even experienced investors who have been around the market for many years then go on to try and time the market, and what I mean by that is buy at low, sell at high, struggle to get this timing perfect every time. And as a result, dollar cost averaging is a friend to both beginner and experienced investors and reduces the overall impact of price volatility and lowers your average cost per share over time. Agenda item number 2. How does dollar cost averaging actually work? In the UK, investors can make use of their ISA savings allowance, currently £20,000 per annum at the time of writing in 2022. And within this, they can opt to allow some or all of this £20,000 to go into a stocks and shares ISA. Via the ISA, the investor can choose the amount they wish to contribute, say to an index fund or an ETF, on a daily, weekly, monthly, quarterly, or even annual basis, with the investments automatically purchased at the time of contribution. Depending upon the stocks and share price in the markets, the investor might see a larger or smaller number of securities from each contribution period to period. So for example, in 1 month, £100 may buy you 10 shares. In the next month, £100 may only buy you 9 shares. Sometimes the investor will buy when the market is high, sometimes the investor will buy when the market is low. But the dollar cost average theory says that over the longer term, the average price paid should be fair/market. Agenda item number 3, the benefits of dollar cost averaging. As already explained, dollar cost averaging can lower the average price paid for your stocks and shares over the long-term period. Secondly, it reinforces the habit of regular investing for the investor and supports their journey to generating wealth over time. Thirdly, it is automatic and can take concerns away from the investor about when to invest. Fourthly, it removes the pitfalls of market timing, such as buying only when prices have already risen. And lastly, it takes emotion out of your investing and prevents you from potentially damaging your long-term portfolio returns by selling at the wrong time or buying at the wrong time. Agenda item number 4. Who should use dollar cost averaging? Dollar cost averaging can be used by any investor who wants to take advantage of its full benefits. However, it may be especially useful to those investors who are just starting out or who don't yet have the experience to better interpret peaks and troughs of the market. It can also be beneficial to long-term investors who are committed to investing regularly but don't necessarily have the time or inclination to watch the market and time their orders. However, dollar cost averaging isn't for everybody. It isn't necessarily appropriate, for example, during periods where prices are trending steadily in one direction or another. It may also incur higher transaction costs compared to lump sum investing, given the recurring nature of purchase transactions on a periodic basis. Agenda item number 5, a worked example. In this example, I'll look to illustrate the benefits of dollar cost averaging over time. Let's assume, in this example, there is a guy named Jack who receives £1,000 per month in his salary, and he decides that he's willing and able to invest £50 a week into the Vanguard S&P 500 over a 10-week period. I'll flash up the maths that underpin these results on the next slide, but if we were to jump straight to the conclusion of the benefits of dollar cost averaging, over a 10-week period, the average stocks and share price paid by Jack is £10.48, which enables him to buy 47.71 shares over this time frame. Now, if Jack had just purchased the shares via a lump sum, £500 on day one would have got him 45.45 shares at a share price of £11 per share, which is less than what he would have got for his money under dollar cost averaging. And this slide helpfully summarises the maths that sits behind those two answers. By using dollar cost averaging, Jack was able to take advantage of several price drops, despite the fact the share price increased to over £11 at some points. He ended up with more shares at a lower average price over the 10-week period versus buying a lump sum amount. What I'll do here is leave the slide up for the next 30 seconds to give you a chance to analyse the numbers for yourself. And that concludes my dollar cost averaging explanation over 5 key steps. Thank you for watching. Don't forget to like and subscribe, and I look forward to seeing you again next time.